Hello, this is Jody Trana with Chapter 1, Part 2 from Principles of Accounting. In business, transactions take place. These transactions need to be recorded in the accounting records. We do this by categorizing the transactions by account. The accounts are then arranged into different reports to show the scorecard for the business. The reports tell us different things about the business, such as how much profit it has made, what the cash level is, and what the capital ownership is. In Star Wars, The Princess Bride, and It's a Wonderful Life, we have some accounting terms mentioned: assets, liabilities, and equity. Let's think about these account categories for a minute. So in Star Wars, the creepy man, whatever his name is, says about Luke Skywalker, yes, he would be a great asset. So what does he mean by this? An asset is owned by a business for the purpose of producing sales. It's really the only reason that a business should hold an asset. The creepy man is saying that if Luke Skywalker could be turned to the dark side, he could produce well for them. In The Princess Bride, Wesley, the farm boy, asks, what are our liabilities? So what's he asking? He wants to know what they need to overcome in order to be successful. Liabilities are not bad. They're just something that causes us to be subject to it. So a loan is a liability. We definitely benefit from getting a loan. So it isn't a bad thing, but we have to pay it back, and that's how we're subject to it. In It's a Wonderful Life, George Bailey has misplaced $8,000 and he's seeking help from Big Bad Mr. Potter. Mr. Potter asks him how much equity George has in his life insurance policy. Equity is the amount of the policy that George actually owns and has rights to, and it's only $500. That isn't enough for Mr. Potter to want to give him a loan for $8,000. Equity is ownership. It identifies the rights of the owners to the assets of the company. So now let's take a look at the accounting equation. It states assets equals liabilities plus equity. Assets, remember, are the things of value that are owned by the company, there to produce sales. Liabilities are the things that we are obligated to. They are provided by people on the outside, the creditors, the lenders, and we need to pay them back, but we're getting a benefit from them. And then equity, that's our own as owners. That's our contribution to the assets. Everybody has rights to the assets. The liability holders, those external people, they have some rights to our assets because we have obligations to them. But we as owners, we have rights to our assets as well. Let's put some numbers to it to see if it makes a little bit more sense. So George Bailey had a life insurance policy, and it was valued at $15,000. That was the asset. But he only had equity of $500 in that life insurance policy. So George Bailey, as the owner of that life insurance policy, had the rights to only $500 of it. The organization that had rights to the $14,500, those were people who provided the other funds or the promise of funds for that entire life insurance policy. Here you see all 5 account categories. We've talked about assets, liabilities, and equity. The other 2 account categories are revenue and expenses. Revenue is the money that you earn from actually conducting business, and expenses are the money that you spend to conduct that business. The reason that these 2 sets of account categories are different colors are that assets, liabilities, and equity show up on one report called the balance sheet, and revenue and expenses show up on a second report called the income statement or profit and loss statement. Now that we've talked about the account categories, we're going to go back to one of our original concepts, and that is transactions. When transactions take place in business, we need to record those transactions into an accounting system. And we do that by categorizing them, okay? So this is the steps that we go through in order to analyze a transaction and to post it. First of all, is it a transaction? There are things that happen in business that are not a transaction. For example, a promise to pay, like a contract. If you just promise to pay something, that's not a transaction because no money has exchanged hands. We promise to pay, so we want to definitely keep track of that. Then what we do is we need to figure out what account categories are affected. That's an asset, liability, equity, revenue, or expense. We need to know, number 2, does it increase or decrease that account? And once we're done, does that accounting equation stay in balance? I just briefly want to make sure that you are understanding the difference between account categories and accounts. Here you see a list of account categories: asset accounts, expense accounts, liability accounts, equity accounts, and income accounts, and some examples of accounts underneath them. So we're starting our conversation talking about the upper level account categories, and the next slide is going to take us into an equity account category and show us a couple of accounts within that. This slide still shows our accounting equation: assets equals liabilities plus equity. But we're expanding the equity section a little bit to show you 4 accounts that are part of equity. The 4 accounts that are part of equity are owner's capital. That's how much the owner has rights to the assets. That's their contribution. Minus owner withdrawals. That's money that the owner takes out of the business as a salary. And then revenue and expenses. All 4 of those accounts we can consider part of equity. Throughout the rest of this narrated PowerPoint, I'm going to go through 9 different transactions and show you how those transactions would affect the accounting equation. The first one is when Sheena Bright starts her business and contributes $30,000 in cash. That $30,000 increases assets in the cash account, and it shows that it increases equity by the same amount, $30,000. Right now, what this accounting equation tells us is that Sheena Bright has 100% rights to the assets in the business. And that's correct because she's the one who contributed them. In the second transaction, Smart Touch Learning takes cash from the cash that Sheena Bright put in, spending $20,000 on land. Both of these accounts are in the asset category. So we're just transferring money from cash to land. You will notice that our accounting equation still stays in balance with the assets equaling $30,000 and liabilities and equity equaling $30,000. The third transaction is the purchase of office supplies. This time they do not spend cash, however. They agree to pay at a later time within 30 days. That creates a liability. We now have an obligation to pay this $500 in the future. So our office supplies increases. That's on the asset side. And our liabilities increase. That's on the right side of the accounting equation. So we're still in balance. By this time, you should be recognizing double entry accounting. Every time we have a transaction, we enter that transaction into 2 locations. Those 2 locations have to correspond to keep our accounting equation in balance. Our fourth transaction, the business earns $5,500 in revenue and they collect that in cash. Cash goes up and our equity goes up, service revenue. That means that now our interest in the assets is even greater. we have $5,500 more rights to our assets because of the service revenue. We've made another sale. This is great. This time, though, instead of receiving cash, our clients promised to pay us within 1 month. That's an accounts receivable. Accounts receivable are still good as long as we receive the cash. Accounts receivable is an account that's in the asset category, so we increase our accounts receivable. We also increase our service revenue by $3,000. We have even more rights to our assets. Our sixth transaction is a compound transaction. In this transaction, Smart Touch Learning pays $3,200 in expenses. Those are for 2 different items, $2,000 for office rent and $1,200 for employee salaries. Both of those items are listed as separate accounts under equity. And we also have our reduction in cash. So keep in mind that rent and salaries are reducing our equity. That's why they are a subtraction. Because we have taken some of our sales and used them to pay rent and salaries, we're reducing our rights to our assets. We're reducing equity by paying expenses. So remember, in an earlier transaction, we purchased some office supplies and promised to pay later. It looks like now we are paying, but we aren't paying the entire amount. We're only paying $300. That reduces our cash by $300 and reduces our obligation for accounts payable by $300. You can see under liabilities, we still have $200 in accounts payable that we still will have to pay. Our client who owed us $3,000 has paid us $2,000 of that obligation, and we record that as an increase to cash, and we record it as a decrease to accounts receivable. That's because their obligation is being reduced because they've paid part of it. So our accounting equation stays in balance because we have done an addition and a subtraction both in the same account category of assets. Our ninth and final transaction shows Sheena Bright withdrawing $5,000 of cash out of the business. This is the proper way for sole proprietors to take money from their business as salary. We show it as an owner's withdrawal, or here you can see it says Bright withdrawals. When an owner takes cash out, obviously cash is being reduced, so we reduce cash and our assets go down. And we also reduce equity because she is reducing her rights to the assets in the business. Through all of these transactions, our accounting equation has never gone out of balance. And that's the trick to double entry accounting. You need to have your accounts always in balance with the accounting equation.